Hello and welcome to Buy Now, Sell Now. I'm Alex Matthew and with me is Cheryl D'Souza. Not the best way to end the week perhaps for the markets, but well, happy Friday to you nonetheless. Not the best start to the series as well. Let's take a closer check of how the markets are at this moment. The benchmarks right now trading with cuts of about 2% each. So over 1,000 points shaved off for the Sensex and about 300 for the Nifty at this point. India VIX up sharply in trade today, as much as 11% from what I can see. Some of this weakness can of course be attributed to the weak handover from the US markets overnight, and of course the overriding factor in that market, in that geography, is the fact that yields have been trending higher. In fact, they've spiked again, and so equity markets have been spooked to a certain extent by that. We're not alone in this. The Indian markets, we're part of the entire pack that has actually seen a sharp sell-off. So most of the Asia Pacific pack is also facing sharper cuts. A quick look at the sectoral indices in today's trade back home, and that'll tell you that it's just the pharma pack that's standing out today with gains of about 1% in trade. The rest of the sectoral indices are all trading in the red, with the Nifty Bank in fact losing the most ground. It has been one of the outperformers both in 2020 and perhaps in the start of 2021 as well because of the PSU banks, but unfortunately the entire pack is down about 3.5% today. Realty, that's been an outperformer in the recent past, that is also lower by about 2%. The market breadth almost the exact opposite of what we saw in trade yesterday. Cheryl, firmly in favor of the declines today.
Definitely, Alex. Looks like firmly in the favor of declines today, and overall market breadth also is very weak. You also have a lot of stocks that are declining in trade, but let's see which are the stocks that are there on a BNSN stock cloud of the day. And first up, I'll talk about RailTel. That particular company had its D-Street debut today. A good debut coming in for RailTel Corp. So that's the first stock that's there on the BNSN cloud. Apart from that, you have South Indian Bank. The board has approved raising 240 crore rupees by issue of shares to top insurer companies as well as ICICI Lombard. You have 16 new entrants into the F&O space. So among them, you have Alchem Labs, AU Small Finance, Deepak Nitride, IRCTC. You have also Pfizer as well, a part of that. Apart from that, if you move on, you have the PSU stocks. Actually, they had seen a sharp decline at open, but they're off the day's lowest point. Need to track that particular segment. You've seen that massive rally come in the PSU segment for a while. So SAIL, BHEL, those are the companies that actually were off day's low. Other company that is in focus, and that is Bank of Baroda. The board has approved the opening and issue of its share sale in yesterday's board meet. The issue price was fixed at 85.98 rupees per share. Also, the bank may offer a discount of not more than 5% on the floor price. Apart from that, you have Hatsun Agro. The company has commenced commercial production at the Solapur plant. And Dilip Buildcon, that particular company is buzzing on back of order win. And also you have Zenza Tech that is also buzzing in trade on back of news flow. So these are the stocks that are there on the stock cloud for the day. All right, and like I've mentioned, the PSU stocks have actually been the flavor of the month. Even after the run-up in the price, the valuation picture is not looking stretched. Jayesh is here with that ET Now Inside. Jayesh.
The PSU stocks have been the flavor of the month of Feb, with the PSU Bank Index surging almost 40%, and the PSE Index also has returned about 21 to 22 odd percent. Despite the fact that there has been a significant run up in the stock prices, the valuation picture of most of the stocks does not look extremely overstretched. Let me break this into two parts. One is the banking space and the other one is the PSU stocks. If you have a look at some of the banks, some of these stocks like IOB along with the Bank of India have surged more than 70%, and their valuation does not look extremely overstretched when you compare it to the 5-year average. Similar is the case for the Indian Bank along with Central Bank of India. 45 to 60% is the up move that we have seen in the stock prices, and both of them trade lower as compared to their 5-year average. State Bank of India, 45% return in this month. The stock trades at about 1.3 times price to book as compared to 0.8 times price to book on an average basis. Union Bank of India, BOB, PNB along with Canara Bank, all of them have seen significant stock moves and the fact that they are still trading below their long-term moving averages as well. The PSU space, if you have a look at that one, ONGC is the one that has given you the biggest up move, 35%, but the stock still trades more or less in line with its 5-year average. Coal India, Power Grid, NTPC also are more or less similar to each other, because all of them have seen more than 20% increase in their stock prices, and the long-term averages or the valuation picture is also very close to where they are currently. So bottom line is that despite the fact that we have seen such a big run up in the stock prices, the valuation picture does not look extremely overstretched.
All right, well, on that note, let's introduce our guest today. We've got Kunal Bothra joining in. Welcome, Kunal, and also Sharmila Joshi. Sharmila, pleasure as always to speak to you. Kunal, I want to start by asking you a little bit, first of all, to tell us about this sell-off. In fact, how do you gauge this? Because, in fact, when you saw that disruption in that extended session, the Bank Nifty took off quite sharply. But, in fact, in today's session, it's actually trading very weak. Perhaps also to a certain extent on account of the yield spiking here as well. But how do you play that entire pack, and what are your high risk, low risk ideas today?
So good morning, Alex. Good morning, everyone. There are three factors to watch out for. So first one, as you rightly pointed out, that the bond yields which spiked yesterday in US markets from 1.3 to almost 1.5 plus levels, I think that's sort of spooking many of the global equity markets. And our markets are also taking cognizance of that. Two of the local factors which I'm keenly watching upon. First one, of course, is the what happened with the derivatives data. So what we saw right from the opening, after the rollovers which happened yesterday and the expiry which happened yesterday, there was a good amount of shorting which is happening on the index. So in the index option, so particularly at 15,000 level, which was actually a support for the previous expiry, is now seeing an incremental shorting on the call option. So that is one factor which I believe could probably result into the index facing a lot of resistance, say for 15,000 on the Nifty and 36,000, 35,500 range for the Bank Nifty. The third and the most important factor, which I believe is again very, very crucial because it tends to give you a sentiment gauge for the markets, is to look at the put call ratios. Now, put call ratios for the monthly, that's for the March series, 25th March expiry on the Nifty, is at 1.86 level. Yesterday, the put call ratio was at 1.9. Now, typically when the put call ratios crosses above 1.6, we term this as an extremely overbought territory. So imagine at 1.9 the extent of overbought nature for the indices. So the markets are going through a natural correction mode. Yes, the global trigger which happened yesterday has sort of led this correction, but I believe that it's also built in because of the overbought nature of indicators. So I would sense that the markets could go through one more round of correction, and this correction could probably intensify in the second half as well. So traders need to be a bit cautious in that aspect. I would recommend a couple of trading ideas. First one which I'm recommending is a sell idea. So it's a short on M&M. The stock forming a pattern of lower highs and lower lows. In fact, at current juncture, it's on the verge of breaking below its short-term swing support around this 820, 825 mark. So would expect a downtrend, a short-term downtrend on M&M, even from current levels. Targets to be kept at 788 on the sell call, and stop loss could be kept at approximately 855. The second is a buy on Wockhardt Pharma. Now I'm expecting that if the market goes into a risk off mode, the pharma stocks should pick up pace and try to balance off and set off the risk from the market. So Wockhardt Pharma is one of the stocks which chartically looks attractive, forming a bullish flag pattern on the daily charts. Would expect a breakout on the upside. Buy with a target of 565 and stop us at 488.
All right, and those are the calls coming in from Kunal for our viewers. Let me reiterate them. The sell call on M&M and a buy call on Wockhardt Pharma. We also have Sharmila Joshi that's joining us this morning. Good morning, Sharmila. And what are your high risk and low risk ideas for our viewers today?
To first just add to what Kunal was saying, in terms of factors, I think another important factor that we are going to hear today is the Q3 2021 numbers. Both my ideas are sort of based around that as a theme. So let me go with the ideas. One is Tata Consumer. This is a stock that I've been recommending for the longest time, and ever since, in fact, the company split, Tata Chemicals split as a company into Tata Consumer Products and the chemical play, pure chemical play, which is Tata Chemicals. Because it was obvious that Tata Consumer was going to get FMCG kind of valuations going ahead, which is what we've seen play out in the stock price. And now, in terms of FMCG valuation, it is all in the price. But I think Tata Consumer still has a way to go. The kind of synergy or scale that they're going for, the kind of acquisitions that they're making, the way they want to position themselves in the market going ahead. Their big basket and their soulful, and the kind of plays that they're looking at seem to suggest scale. So I think you'll have to give the stock for all that to play out, which is why it becomes high risk really, not for any other reason. So Tata Consumer would be the high risk idea because it has run up a lot, and now you need to give it time for these positives to play out in the price. Having said that, I think there is a good 15-20% upside from current levels. The other stock is Kotak Bank, which is probably more closely linked with the kind of GDP data that we may get today. We are expecting a slight positive in that October to December period after the deep cuts that we've seen first in the first quarter and second quarter. We saw an improvement, but obviously still negative. So if we come to the positive territory and if the number is anything better, is a little better than what is expected, then you will see buying return to financials as a space. And even if it doesn't, I think still Kotak Bank still holds out. Kotak Bank is the stock that I'm going with. The kind of numbers they've reported and the kind of possibilities that are there in terms of growth for the bank going ahead make this a stock that I like within the banking space. So Kotak Bank would be my low risk idea.
All right, Sharmila is looking very closely at the macro numbers that will come out later today, and we will do that as well in the meanwhile. Sharmila and Kunal, do stay with us. We'll come back to you in just a bit. And to you, dear viewer, do stay tuned. We'll come back in just a bit from the break.
Welcome back. You're watching Buy Now, Sell Now on ET Now, and definitely not a good day for us. At least it doesn't look like we are ending the day on a positive note. We've got a weak handover coming in from the global markets, but if you see the markets right now, the sell-off has actually picked up steam. So you have the benchmark indices that have fallen over 2.5%. So you have Nifty that is seeing actually a drop of over 350 points. You have Sensex that's seeing a drop of about over 1,300 points. Broader markets are also falling, but little less than the benchmark indices. You have VIX also that is rising right now. You have the VIX that is up about 16% in trade. Even the Asian markets are seeing steady decline. You have Hang Seng, Nikkei as well as Kospi, all three of them down over 3% currently. Even Shanghai is down about 2%. And like I said, the sell-off is picking up steam right now. You can see a cut of over 1,400 points on the Sensex. So that's the market setup for us, not looking pretty good for us as of now. But let's move on and let's get on board our viewer query for the day. And the first query is coming from Uttam Garg from Delhi, and he's written to us saying that he's bought SBI at 380 rupees per share levels. He wants to know whether he should book profit or hold. Kunal, I'll come first to you on SBI. Stellar rally coming in from SBI. Right now, the stock is at around 390 rupees per share. What should our viewers do, considering that the PSU banks has seen a sharp rally? This sort of question definitely arises in everyone's mind. Is there more steam for this rally or no?
There definitely seems to be more rally on charts, at least for SBI. It's broken out of a 10-year consolidation, and generally when we see a 10-year breakouts happen, the stocks, they tend to do pretty well over the next 2 to 3 years. So I think purely as on charts, I think SBI should do pretty well. And also I think there's this inherent theme towards PSU stocks as well. So it has the advantage of both breaking out of this PSU banking, pack, as well as the PSU advantage, where you're seeing a lot of money flow, getting back into this sector. So I think on the back of this, SBI should do pretty well. Now, the only catch is that if you're looking to average further, then I believe that you should wait for some more time. I think the stock comes back to say a 350, 360 zone. That should be a good level where you can look to average further. You don't need to average this on highs. Wait for those strategic corrections which comes across into these names. For SBI, I would suggest the hold and an average if the stock comes to 350, 360 zone.
All right, Sharmila, I want to come to you on this one. And in fact, ET Now just recently spoke to Mr. Dinesh Khara, the head of SBI, and he spoke about the retail book growing very sharply. He spoke about, in fact, his plan to increase the real estate book or the home loan book for SBI. That's going to be a focus. A lot of people actually saying that SBI, even at this point, not necessarily very richly valued. So would you hold on?
Yes, I think my only concern as far as the investors' query is that his buying price is a little high. 380 is a slightly high price to have entered the stock at. But, I think as Kunal was saying, I definitely see an upside in the stock. But I think I would like the view to be slightly long-term because, as you said, this has been among the better performing PSU banks and probably the only bank, really honestly, that I would recommend in the PSU space. You need to, they have sort of flagged off certain areas that they will focus on going ahead, and you need to give them time for those positives to play out. But in terms of valuations, in terms of the numbers they've done, and in terms of their approach, I think the box is ticking, the stock is ticking all the boxes. So stay invested, but make sure that your view is slightly long term.
Incidentally, it's I think that market veteran Pratik Gupta also has a similar view on SBI. He remains bullish on SBI in the PSU banking space. Listen in to what he had to say.
Within the PSUs, the only stock we really like is SBI, given its strong, liability franchise. They've cleaned up the books quite well. Capital adequacy is decent. There are some very well-performing subsidiaries as well. But as far as the NBFCs are concerned, I think we like some of the better quality NBFCs, especially some of the auto financiers, where they have a strong, they haven't really been blown up by this asset quality issues, where the capital adequacy is decent, and where most of these companies have the ability to raise more capital in the next couple of years. They're not, they've not really blown up their balance sheet as such. And we think some of these will actually come back to the growth path in FY22. But I think in the NBFC space in general, and especially in a rising rate environment, you have to be a little bit careful. So our preference would still be the private banks, but some of the top quality NBFCs, we would go for those as well.
All right, another question then, this time from Nagaraju, who's written to us. He wants to know a view on Infosys, Sharmila, and I'm coming to you on this one. He's bought 200 shares of Infosys at a level of 1,349 per share, and that is more or less at the peak that we've seen in the recent past, right? The 52-week high at least was 1,387 or thereabouts. So would you recommend that you hold on to this, or should he should he average at this point? Because I wouldn't think it makes sense to sell.
The two sectors that I like, in this market are, which have been sort of favorites for this past year, have been IT and pharma, and both for, their own sort of reasons. And I think IT has sort of proven with the kind of numbers that they have delivered that this is a sector that will perform going ahead. Once again, I think here, the thing that I don't like is the buying price. Obviously bought at when the market was at its highest and IT was at its highest, and now that you're seeing a correction in the market, I think investors get worried. But I would think that IT would be the one sector where you can sort of keep your fear at abeyance, because this is being supported by numbers. This is a rally. The IT rally has been supported by very good numbers in all the top 4 IT companies that we have. The stock that I like best within that space is HCL Tech, but I think Infosys is definitely in that list. So I would continue to hold, and that would be my recommendation. Once again, I hope that the investor wants to stay invested in Infosys for the with a slightly longer term horizon.
Call coming in from Sharmila for Infosys. Kunal, what's your take on Infosys? Definitely the buying price is pretty high for our viewer. It's near the 52-week high levels for Infosys. 1,349 rupees per share is what he bought 200 shares at. So what should he do with the stock right now? Should he sell or remain invested?
And I would say an urgency which an investor needs to show in terms of selling the stock. It's a classical story. We've seen IT stocks doing exceptionally well. They've managed to break past about their major highs and on multi-year basis. So in that aspect, there should be a lot more upside on a multi-year basis. Now, what has happened actually, the reason why the IT stocks are falling is because the indicators for many of these IT stocks in the November and December rally had gone back into an extremely overbought territory. In fact, I had done a chart buster segment as well on the Nifty IT index at that time as well, indicating that how the weekly RSIs for the IT index had come back to 90 plus zones. Now 90 plus zones on the the RSIs are extremely overbought territories. It results into at least a 3 to 6 month cool off, which happens into the stock prices. So what we are seeing is in effect a mean reversion process or a cool off process for many of these IT names. I would expect that probably for another couple of months you might see this index these stocks going through a downward drift. But if these stocks come back to their support territories, one should look at them as an opportunity to buy back again. So for example, for Infosys, I think there seems to be a strong support at this 1150 to 1200 kind of a zone, 1150 to 1175 to be more precise, as a kind of a zone, which could also coincide with a lot of long-term moving averages as well. So in effect, my answer is that hold on to your stock on Infosys and look to average if the stock enters into this range of 1150, 1175 and have a long-term view for the stock.
All right, that's the call coming in from Kunal on Infosys. Let's move on and let's get on board our next viewer query. And this one is coming in from Nageshwar Rao. He's saying that Apex Frozen Foods shares fell post their results. The management is saying that they aim to resolve the container shortage issue. So he wants to know whether this is the good time to enter the stock. On the charts, Kunal, how is Apex Frozen Foods looking like? If you look at the stock over the last 5 days, definitely has not been a good time for it. Even in the last 1 month, it's dropped about 13%. So is it the right time to look at Apex Frozen Foods? How is the chart looking for that particular company?
Not really, Cheryl. In fact, I would suggest an exit on the stock. The chart patterns are not encouraging as such. It's been going through a downtrend since last 2 months from 320 to 240 at a time when the markets were going through a peak of or a very strong uptrend. So the stock has been an underperformer, and as it is when the markets go into a risk off mode, the laggards and the ones which have generally weaker chart structures, they are the ones which are under some severe selling pressure. So I would assume that probably this stock as well could go through a downward drift if the market continues to go into a risk-off mode where you see gradual corrections creeping by into the indices. So in that aspect, I would suggest an exit from the stock.
All right, Sharmila, coming to you on Apex Foods, it's a stock that's faced a little bit of issue with things that perhaps are beyond its control from overseas, right? And it's basically the question is that the management aims to resolve container shortage issues, but then it's one thing after the another for this stock. So would you recommend entering at this level?
I would agree with Kunal. I think this doesn't seem to warrant that you enter. One is, of course, I think all the reasons that you outlined in terms of the various issues they've faced in the containers, etc. And also, what we've really seen over this last year is that there have been, as you said, one issue after the other for this sector. And even when you talk of consumption as a play, I think this is too niche. So, at a time when market is correcting, this may correct out of proportion to markets, which is the point Kunal was trying to make. So I think if the market corrects further, it might make more sense to enter into, say, like a Tata Consumer, which I mentioned earlier, or a more slightly different sort of a consumption play rather than such a niche play. So for me to, Apex Frozen Foods is a no at this point in time.
All right. Kunal, I just want to mark the Nifty Bank. From what I can see, this index as a whole is trading extremely weak, and I know you broached it when we started the program, but I do want to ask you for a technical check as we stand. What are you seeing in the near-term charts for the Nifty Bank as a whole, and what are the levels that our viewers can watch out for?
As I was mentioning, start of the show, Alex, that there seems to be a structural, correction for the index. And the chart structures are definitely weakened down. There has been aggressive selling on the call writing as well. That aggression generally shows, when there is, almost, a very high degree of confidence from traders where, the markets could probably go into a trending mode. And that this time around as well, the expectation is that the markets can go into a downward trending mode. Now, one of the major support levels for the Nifty, or for the Bank Nifty rather, was the previous swing low, which was at 34,970. So, to make it more precise, I think it was 35,000 support levels. Now, Bank Nifty, as we speak, is trading exactly at that key support level. So a break below this support of 35,000, and assuming if we close below it, then we are talking of a possibly and a potential almost 1,000 point further correction on the Bank Nifty. So this is a very, very important support for Bank Nifty, and which is why I was mentioning this caution for many traders, because I'm sure that after those 2 days of rally, traders would definitely have more of long positions skewed towards it. So break below the 35,000 mark on the Bank Nifty, I believe, could result into at least 1,000 point further sell-off in that index.
All right, so that warrants caution. Thank you so much, Kunal, as well as Sharmila, for joining us on this program and for sharing your views. Do stay tuned. We'll come back in just a short while with more on the other side.
Welcome back. You're watching Buy Now, Sell Now on ET Now. And let's move on and let's talk about auto sales on March 1st. We will have the auto sales for the month of February. And what are the polls indicating? Vivek is here with that. Vivek, how are the auto sales for the month of February looking like?
The auto sales numbers would be coming out on 1st of March. Now remember, given the fact that this is the last working day or the last trading day of February, most of the analysts have started coming in with the analyst notes as far as the expectations for sales figures are concerned. Now Feb wholesale figures, as per analysts, is expected to grow YOY on a low base for all segments excluding the three-wheeler segment. Now this is mainly driven by the fact that new launches and sustained urban demand recovery has been witnessed. In fact, the passenger vehicle segment continues to see a very healthy demand trend. Wholesales are also expected to grow for replenishing abnormally low inventory for both passenger vehicles as well as tractors. So it'll be interesting to see how the stocks react on the back of these particular and what kind of expectations are being built in by the market. Now, given the fact that the commercial vehicle space channel checks are actually indicating continued demand, and this is mainly led by the replacement as well as new fleet additions. Now, demand for entry-level two-wheelers remain quite subdued at this point of time. However, the premium segment has seen some recovery according to dealer checks done by the analyst community. Now, talking about the numbers themselves, Maruti is expected to see a year-on-year growth of close to 3%. 1.52 lakh is the kind of numbers expected. M&M, both, when you're talking about the tractor business, expected to see a rise of 35%, and the auto segment is expected to see a rise of 6% on a year-on-year basis. Escorts is expected to see a year-on-year increase of close to 18%, close to the 10,150 mark, while Tata Motors passenger vehicle and commercial vehicle both are expected to see strong growth. When you're talking about Ashok Leyland, you're expecting to see a 22% increase, close to the 13,970 units is the kind of sales figure that analysts are penciling in, while the important two-wheeler part, TVS Motors are expected to see a growth of close to 12%.
All right, and Maruti, in fact, from the auto pack, perhaps one of the bright spots in today's session, with cuts of about 3% for the benchmarks while we're speaking. But there is an interesting view that came in from Morgan Stanley on Maruti, which I just want to point out to you. They remain overweight on the counter with a target of 8,775 per share. And the reason they're talking about this is that Suzuki has announced a medium-term business plan for FY21 to 26. And they're also factoring the retirement of the chairman, that is Osamu Suzuki, which was announced not too long back. They've factored the fact that the plan had broad outlines on the future strategy, where they're looking to maintain market share of more than 50% in the passenger vehicle segment in India. They're also planning to introduce electric vehicles and strengthen their SUV segment, one of the best performing segments in the country as of now. And they're also looking to promote CNG in a big way in India. The company is apparently working towards improving ESPs and electrification. That's basically what is causing Morgan Stanley to be confident on Maruti Suzuki. Let's also look at the MSCI. They've announced changes in the weightage of stocks in the MSCI Standard Index, and Vivek is back to tell us about those weight revision details.
Well, it's been an important and a busy week as far as passive fund managers are concerned. Remember, we've had a couple of changes. At the start of the week, we told you about how the FTSE was making changes to the All World Index. We also told you about how NSE was making changes to most of its indices, with the key change being the inclusion of Tata Consumer within the Nifty. Now, today again is an important day for the MSCI. Now, remember, MSCI earlier had announced changes as far as weightage of stocks in the MSCI Standard Index was concerned. Now, most of these weight changes are effective from 1st March, and which basically indicates that all of the rebalancing in order to meet the changed weightages would be happening today. Now, let's look at some of the stocks that would be in focus. One stock that will definitely be in focus would be Bharti Airtel. Remember, Bharti Airtel has seen a seesaw saga as far as weightages in global indices was concerned. You first saw the foreign inclusion factor, or the FDI limit of the stock, which was earlier pegged higher, actually falling down to 49% after some of the subsidiaries of the company did not receive the required approvals in time. Post which you saw the stock price drop drastically, given the fact that passive funds were forced to sell the stock. And now again, the company has got all of the approvals and the increased weightage has happened, and MSCI said that they would be considering this weightage. So now fund managers as well as analysts estimate that flows between $450 to $600 million could be expected within Bharti Airtel. Indus Tower, HDFC Life as well as ICICI General are some of the other stocks that would be seeing some flows today, while Reliance, Infosys, HDFC and ICICI Bank will see some outflow on the back of the fact that there is the rebalancing that is happening today.
For getting us that update. Alright, on that note, we'll slip into a break on this edition of Buy Now, Sell Now, but stay tuned, more news on the other side, don't go anywhere.
Welcome back to Buy Now, Sell Now. Well, as we have spoken over the last 50 minutes or so, the market sell-off has intensified, with the Bank Nifty, in fact, losing more ground. But right now, let's take a check on cement. And in fact, my colleague Vivek Iyer did a check on cement on the cement channels. And in fact, what he's essentially trying to tell you about is the prices and whether or not they'll go up in March. Listen in.
Well, the sector in focus is the cement sector. We spoke to a whole host of dealers, and what we understand in that, especially in the South Indian states, we understand that dealers are expecting price hikes of almost 20 to 30 rupees a bag from 1st March in South India. Now, this is a significant price hike, and this is mainly on the back of the fact that companies believe that there could be slightly better demand, and they're also looking to offset higher input prices. The other important thing is that these prices are most likely going to be effective from 6th March, as there is a 5-day dispatch holiday. Now, talking about North India, prices are up by almost 1 to 3% on a monthly basis. We understand that North Indian demand has been supported by receding winter season, helping fast forward the pace of construction work. Now, talking about Western India, demand has rebounded, led by recovery in construction activity. Prices here too are up by almost 1%, close to the 350 rupees per bag mark in Mumbai. When you're talking about Eastern India, demand has been quite strong. However, prices have been constrained over here on the back of the fact that there has been aggressive expansion undertaken by various players here. So capacity too is quite high as far as Eastern India is concerned. Central India India, when you're talking about prices, have been quite flat on a month-on-month basis. UP prices have managed to go higher by 1 to 2% month-on-month, but Madhya Pradesh prices have remained quite flat. Overall, the story remains the fact that cement prices, along with steel prices and commodity prices, is on a strong footing, and in fact, South India players and South India companies are the ones to keep an eye out for, given the fact that price hikes may be around the corner for them.
All right, thank you, Vivek, for getting us that details coming in on the cement sector, where they are likely, dealers checks indicate that the cement companies are likely to hike prices on cement. All right, it's time now for the Buy Now, Sell Now quiz champion. And the question that we asked today was, which of these plastic pipes and fittings players registered the highest revenue growth in percentage terms in the Q3 FY21? And the options were Prince Pipes, Supreme Industries, Apollo Pipes and Finolex Industries. And the answer to that question was Supreme Industries. So let's take a look and let's see who are the winners. And the two quiz champions of the day are Irshad Manoli as well as CB Dhariwal. So they are our BNSN quiz champions for the day. And as we wrap up the show, let's take a look at this quick explainer that's been brought by Alex over here on how stock exchanges function. So take a look at this ET Now report.
A stock exchange is essentially a marketplace where shares are bought and sold. Back in the day, this used to be done physically, with brokers shouting buy and sell orders. It was quite literally pandemonium. Today though, everything happens electronically. Let's take a look at how this works. The stock exchange is part of a network. Imagine that it sits on one end of that network. On the other end are its partners, trusted, registered entities like brokerages and banks that execute trades on behalf of individuals like yourself. Information in the form of data packets flows back and forth between the stock exchanges and its partners in real time using a technology called multi-protocol label switching, or MPLS, via internet service providers. The exchange uses this to broadcast the prices of the stocks that are listed on its platform in real time to its partners. At the same time, the clients are punching in trades based on those prices, both buy and sell. The stock exchange processes this data using an algorithm and finds the best match for buy and sell orders, thereby making sure that trades go through. So essentially, the network between a stock exchange and its partners is like a conduit or a pipe through which the data is constantly being transferred. Except instead of there being a single pipe, there are multiple pipes that are controlled by telecom service providers. Exchanges also normally have a backup in the form of a disaster recovery site, so that even in the event of a natural calamity, information is never lost and usually the transference of data continues to take place. When the National Stock Exchange announced that it was facing technical difficulties, what happened was that data was not flowing from the stock exchange to its partners. As a result, the prices of securities were not updating. However, data from the partners continued to flow to the exchanges. Effectively, one end of the conduit was blocked off. Well, that's how stock exchanges work. For more news and updates, do stay tuned to ET Now.